everybody. Welcome to the Energy News Beat podcast. My name's Stuart Turley, President and CEO of the Sandstone Group. Today is NAPE, and you're probably tired of listening to us, but we are having so much fun. My next guest is Jeff Krimmel, and he is a energy extraordinaire, I think is a free. I'm his favorite stalker on LinkedIn. You have got to follow him there. Welcome, Jeff.
Well, thank you so much for having me.
I'll tell you what, I love your work. Your analytical mind on what you're writing out there is very cool.
Well, I appreciate you saying that. It's an area that I make sure, it's deliberate that I steer in that direction. There's a lot of conversation around energy, and frankly, a lot of it's very good. And I feel like one area that I can contribute is by using data and communicating from that data, kind of telling my own story around that data, but sharing the data so that other folks can decide whether they agree with the narrative that I happen to have constructed or whether they want to challenge it or come up with their own. And I feel like it creates a pretty fun dialogue.
You know what's fun is when you take a look at some of your analytics. Let's go through the one on Oxy, because you sit back and kind of wonder, why does Warren Buffett own so much? There's got to be a reason.
Yes, the most recent analysis that I had done on Oxy was, and you see it in two different ways, but they are one of the higher cost producers amongst U.S. independent E&Ps. And you see it in terms of, I performed some estimated break-even oil price calculations. They have break-even oil prices north of $55 a barrel. But you also see the post I wrote about most recently was in their finding and development costs. It costs them more to find and develop a barrel of reserves than almost anyone else that I had tracked, of the big players, of the big U.S. independent E&Ps. And that's worth paying attention to, because we're in an environment where long-term global oil demand, there's real uncertainty about what happens there. And there's real hesitation in getting aggressive around CapEx, as we've seen. This is the era of capital discipline. And so knowing that the whole industry is trying to be very selective about how they deploy CapEx, and that the hurdle rates to justify making these investments have gone up over time, that finding those operators that have the least margin for error is worth understanding, because it'll tell us a little bit more about how we might expect the future to unfold.
Do you think their carbon capture side of it is going to make a difference?
So there's a yes and a no answer to that. The no answer is probably simpler in the sense that, if you strip out what their spend around the direct air capture investments, they still would be the highest, finding development costs in the amongst this cohort of independent E&Ps. But yes, in the sense that this is the challenge. I think there's a lot of merit for any oil and gas company to chart their own path into the future and decide what role are they going to play in the context of carbon. And I know that Occidental describes himself, at least in part, as a carbon management company. And so there's say that element. There's another element where there's many more oil and gas companies that are committed to driving down the emissions intensity of their own operations, right? Try to get that down as small as possible. That's separate from capturing carbon that's already been emitted in the atmosphere. Then there's ostensibly some cohort of the industry that doesn't pay a whole lot of attention to carbon emissions at all. And so there's merit in, I could see a management team justifying to, if you're a publicly traded company, justifying to their shareholder base, or if you're privately held, justifying to your ownership group, why we're going to chart any of these three paths, okay? Now, the challenge becomes, whatever path you choose, there's going to be some advantages and some disadvantages that go along with it. And the wider the portfolio of opportunities that you make available for how you might deploy your CapEx introduces the possibility of confusion, of uncertainty, of suboptimal deployment of capital, right? Now, it also opens up, there's real possibilities to play, like Oxy could, be a meaningful contributor in carbon management, carbon retrieval directly from the atmosphere. So there are wins to be had there. But I do think it makes charting a path through your capital expenditure programs more fraught than it otherwise would be.
Wow. I'm sitting there kind of thinking, now, if I'm an investor looking at Oxy and they've got the most expensive in the top tier for looking for new oil and gas in their thing, how do they continue on in their CapEx budget? It's going to be, they're going to have to stick with tier one land, because if you've got low costs, you can go to the tier two levels and be okay. But if you're at the high end of that cost margin, you're going to have to stay in tier one. That's going to limit on getting good deals on oil.
Yes, it is a fair statement. The assumption that becomes really interesting, and I'm sure this is what the pro Oxy argument looks like, is costs are higher today than we would like them to be, but that means that there's an enormous opportunity to drive those costs down. Right now, I've not heard the details around that story about where some of these cost inefficiencies might be that they're working presumably every day to pull out of their organization, right? But so it's possible, right? There's clearly an opportunity to improve, and that in itself is exciting, and you can build an investment thesis around that if you believe that, okay, the company has identified these sources of cost inefficiency and really are targeting with the corrective actions to go capture those dollars. But if you think that, no, like structurally, this is just a high cost business relative to other business for any number of reasons, it's the result of subsurface realities or how we execute our programs, then like you said, you're restricted two ways. One, you're restricted geographically. You need as favorable a subsurface environment as you could find. Two, you're even more levered against attractive oil prices, right? If oil prices start retreating, you're the one that's going to be hurt first. And so then you start getting into, okay, do we start hedging more aggressively than our peers do? Like, there are subsequent conversations you have if you believe that just structurally we're a higher cost organization.
That's right. I mean, if we take a look at Lee Zeldin, I mean, who would have guessed, Jeff, I did not have this on my bingo card, that Lee Zeldin would be told by President Trump, for every one new regulation over at the EPA, you have to get rid of 10. Now, how cool is that? And so as an EMB operator out there, we're all taking a look at regulatory issues, and saving the cost of getting rid of 10 regulatory issues is huge. That's going to help everybody.
Yes, there's something that gets very interesting about this dynamic. And it is that interesting, right? When you look at, say, the world of big tech, there's a lot of complaints about, is big tech underregulated? And in certain areas, might it be overregulated? And some of the biggest tech companies, right, rather strangely, have lobbied for increased regulation of the tech sector. Well, why would that be the case? In almost all situations, if you increase the regulatory burden in any economic sector, that disproportionately targets the smaller players, right? The bigger players have all the resources they need to manage almost any regulatory environment that's conceivable. But when you start peeling back regulations, what that does is unlock this tier of the market that otherwise might not even exist, right? So there's small to mid-tier operators for whom, if you eliminated enough of these regulations, that's the difference between them being in business or not, or expanding their business or not expanding their business. And that's where I'm very curious as we march forward in time. And if there really is a push, if this deregulatory momentum picks up and there's real deregulation that happens on the back end, what I am most curious to see, what I would expect to see, is that the largest players don't actually change a whole lot. Maybe the extra profit dollars they generate, they funnel back to shareholders in terms of dividends and share repurchases. But I think there's this segment of the operating community, mid-tier and below, that really might see a meaningful difference in how they can execute their businesses. And I'm curious to see how that segment of the market responds.
It is going to be pretty interesting, because is it around the 50% of our oil is made of the privates?
That's a good question. I don't know offhand.
I hear the number. Sometimes I hear it's between that range or something. So is it the majors? Are they going to benefit most from this? I like the way that you did say that, and say if they do benefit, they're going to be able to afford their share buybacks. Because I think that the ESG mode did do a good thing for the oil and gas in one respect, or that is shareholder responsibility has really gotten hold. It is not going to be drill, baby, drill. It's going to be drill, baby, with this kind of responsible is really what that's going to be.
That's right. And you are exactly right to comment that, say, circa over the past 10 years, there has been a real change in how, in the way that these largest oil and gas enterprises are governed. And I agree that it's a change for the better. It's leading to, it cascades down and leads to more responsible and responsive management. And it leads to more predictability in the market that allows all stakeholders in that market to thrive. So it is a healthier spot today. While there's all the turmoil that exists and that we're aware of structurally, and it's a message, because I do speak in front of a lot of industry groups, and I try to make it clear that, like any economic subsector, you can pick out elements of what's happening and choose to be pessimistic about it, choose to be the woe is me. There are a lot of reasons to believe that now, within the U.S. oil field, say specifically, is the most exciting time to have participated here. And one thing that I keep saying is the returns to best-in-class performance today are higher than they've ever been, because there are some of these constraints, like all these hurdle rates have risen. So if you believe that you can play the game at the highest levels, you will see a greater return today than you ever have, I will argue, in the history of the U.S. oil field. And that's an incredibly exciting thing to think about.
Now, I'm thrilled out of my mind with my investments in oil and gas right now, because I'm getting about 32.1% on my returns. I like my returns, and that's not even including the tax deduction. So if you pick your return and your investments, you're doing good. But Jeff, as the head of your consulting gig, who are you looking for, or who are your clients, and what kind of services do you provide?
Yes, I work with energy executives, industrial executives to use market intelligence to create better business plans and to make better business decisions, right? So one example of a project that I've worked on in the past is a senior vice president at one of the largest engineering, procurement, construction management firms pulled me in to help his group. They were going through what they call their annual growth and investment planning exercise. So they're an EPCM company. They work, their clients, right, are the big operators that are trying to build massive facilities all over the world. This particular group looked over 5 different industry subsectors, looked over a couple of big geographic regions, and they wanted to know, where is capital flowing in this space? Like, we need to invest to meet our customers where they're going to be. Where do we see capital flowing across these different spaces? And so I used a bunch of market intelligence data, capital spend data, macroeconomics, supply demand, all that kind of stuff, and create a narrative around this is how I think, CapEx is going to be deployed going forward. And so this is how I would position this business to respond. And then they have 5 different VPs in their group that each came up with their own business plans. I came in with a narrative informed by what the market data was saying. And then we worked together to triangulate around, okay, what is sort of the most robust business plan that acknowledges the realities of the market, the data that I found, but also acknowledges the reality of the business, as each of these people know, because they run it every day. They talk with their customers every single day. And so that's where I specialize, is helping bring this market intelligence bit into a conversation. Right now, we're relying exclusively on market intelligence to tell us what's to be built. Now is taking that internally, and we need to marry that up.
And being from an outsider looking in at your analysis and how you can articulate that, oil and gas executive, if I'm in the whatever state it is, I want you to be a contractor for me, because I'm telling you, I love what I see when you're working out your stories and everything else. I like the way you think. I can see that as an executive saying, okay, I'm not sure about this, and what you've got out there as far as Jeff, I'm going to be honest, those may not be what you had inside. What the guys on your bench may be absolutely wonderful and just need a little bit extra expertise.
Well, I appreciate you saying that. The idea of being an outside perspective is important. It's an important part of the value proposition that I have, is that I don't know the internal lot. I come up with something separate from that and bounce it off, and then we can try to meet in the middle. Or even if the internal line is exactly the right line, it builds some confidence by seeing, okay, this is
First case is it's also a good check with your guys, inside or gals, being outside President Trump on the last election. He thought outside the box and went to podcasts. And I mean, he knocked it out of the park by going on some of the strangest podcasts, not like the one podcast that the other Kamala went on, whatever that one was. But podcast, looking at the box, is how the executives really need to look at things. It's not the same old status quo here.
That's right. It's in that vein, one thing that I try to make clear through the analysis that I do is I am not an industry cheerleader, right? So I am not here carrying water for oil and gas. I do a lot of analysis around oil and gas. Some of it is very positive, uplifting, and some of it is I do try to expose. These are real challenges of gas.
I would prefer to have that kind of an issue as opposed to, here's everything you want to hear.
Exactly right.
That's not, if I'm a CEO and I want to make a decision, I want truth.
Yes.
Give me the truth.
That's exactly right. And it's why, in addition to oil and gas, which I'll be clear is the bulk of the analysis that I do, it's my personal background is through oil and gas. I also analyze the renewables spaces, nuclear, coal, everything that touches the broader energy market. I try to make sure that I'm analyzing. I'm finding data sets that tell us that from which we can pull observations of consequence.
Right.
Because I believe that in order to make great decisions inside of oil and gas, or inside of renewables, or inside of nuclear, where you need some fluency in what's happening in adjacent parts of the energy.
You're almost describing Chris Wright. And the way you're describing Chris Wright is there's very few folks like you that are looking at the entire energy perspective. Chris Wright understands nuclear. He understands the world. He understands all of this kind of stuff. And so, I'm over here, I'm probably Chris's biggest fan out there. And when you take a look at that as a Secretary of Energy, that's what we need, is somebody that looks at the all of the above approach.
Yes, and when you do that, you get a lot more information about why energy systems look the way they do, why they have the inertia that they have, why they do or don't respond to capital the way that they do. There's just a lot of
that's a great
dynamics. Yeah, and it's
holy smokes.
And you don't have to kind of lose your mind going down every nook and cranny of every energy subsector, right? If you take some time and kind of broaden out and use a wide enough lens, but do it with some rigor, so that you're making sure that you're using real data to understand what's happening and why it's happening. I have found you can tell very powerful stories about why each of these energy subsectors is evolving the way it is. When it comes to executives trying to make business plans or trying to pursue mergers and acquisitions or any kind of element of your capital allocation framework, having that sort of narrative that's being informed by the market to bounce off your internal points of view only make the results stronger.
Oh, absolutely. So I'll tell you, what do you see coming around the corner? Because we have AI. When you have Bill Gates up there saying, oh, by the way, we need more natural gas. Did not have that on my bingo card for 2 weeks. You have Larry Fink saying that as well. And you look at the U.S. map, Texas is really the only grid that's on target to meet its growth path for new natural gas plants coming online. I've looked at the other grids, what they have online and what the budget is. I'm not seeing a real good pattern here.
Yes, I agree completely in the sense that there is a sort of an awakening understanding that we really will need basically as much energy as we can pull together. And one of the many beauties of, if we're going to talk the U.S. market specifically, is that people are more or less free to deploy capital as their conviction allows, right? So there are sub-segments of capital holders that believe very deeply in renewables, want to deploy toward them. There's some that believe very deeply in nuclear and are working hard to overcome obstacles there. There are other folks that understand the promise of what natural gas can bring going forward, given the maturity of the infrastructure that exists in the natural gas domain, and they want to deploy their capital there. And Texas in particular, right, is the kind of state where anyone that has enough capital and enough conviction can come deploy it in almost any kind of direction.
Exactly.
To the extent that I have a personal rooting interest, I would hope that more of the country, more of the world comes to this realization that if you set up markets in a way where people that have capital, that have conviction, can deploy against that and then see what happens, we will wind up with more effective energy systems. They might not, it will look like a hodgepodge. It will look like kind of this bizarre Frankenstein's monster type collection, but it works because we're growing it in a way that meets the demands coming online, and the market helps us test these different technologies, and so we do settle into.
I like the way you think. It's kind of. I'm sitting here going, if the whole world could be more like Texas, as I'm sitting here at NAPE with a cowboy hat on, that's not a bad thing.
And I think a lot of people would agree. A lot of people look. I listen to all sorts of podcasts and read analyst reports, and there are a lot of commentators that point to the power specifically, that will point to the Texas power grid and say, look at how low the prices are. Look at how diversified the mix is becoming. There's a place for almost every energy technology that exists there. And there are a lot of places in the world, in principle, that could look like that. There are a lot of embedded resources that would allow us to harvest energy, again, from all kinds of technologies in all kinds of places around the world. And half the story seems to be, can we get out of our own way to do that? But also do that in a responsible way, right? No holds barred, right? We do need to protect ourselves. We need to protect the environment. We need to make sure everyone's playing by fair rules. Like there's expectations that we need to make clear about what the rules are, but don't unduly impede the ability of capital to flow towards areas of need. And I think we'll find it remarkable what kinds of energy outcomes we can generate.
We have got to, like Chris Wright has basically said, why we can't hit net zero by 2050. We can't hit net zero by 2030. Not going to happen. But what we should strive for is net energy poverty zero. That, to me, is where we need to do that with the least amount of impact. So the best thing that we can do is guide people to delivering the lowest kilowatt per hour to everyone on the planet with the least amount of impact on the environment. And if it's sustainable and fiscally responsible, boom, we're in energy nirvana.
Yes, there's a lot of reasons to believe that if you set it up the right way, you can get to an era of energy abundance that is also even more sustainable than what we're doing today.
Right.
And that's why, in terms of my energy analysis game, I try hard by design not to evangelize, like I say, Bart, not to cheerleader. And I don't really evangelize for specific technologies. What I feel like the value that I bring is studying the data around why the market looks the way that it does today. And knowing what's happening, what should we expect the market to look like going forward? What do we want it to be? But what should we expect given the dynamics that actually exist on the ground? And yet, if you were to ask me, what am I rooting for? There are a lot of ways. I wrote a post just the other day on LinkedIn about China, and China right is putting a bunch of capital toward solar and wind farms. They're also building new coal-fired plants. They're also building new nuclear plants.
Right.
And you can tell that there is not a strictly low-carbon agenda. There's not a strictly green energy agenda here. What this is China finding a way to simultaneously drive the cost of energy down while making sure that energy is available and is secure given their domestic resource base.
Right.
And so I think that you're right that in the past, say circa 2020 to 2022, there was an abundance of conversation where we're going to talk about energy strictly through the lens of climate. And it's not that climate is unimportant, that the environmental implications of our energy systems matter.
You bet.
And yet, there are other things that also matter. Energy affordability and energy access are two things that matter.
Right.
And so we're now at a point, and this is what I am hoping, that no one lens of those three can you rely on exclusively to give you the right answer. There is some blend across all of them. And it's why I say, even in the oil and gas space, there's a big push to finding how can we drive the methane intensity of our own operations down as low as we conceivably can. And in some cases, how do you can make negative emissions for the operations, for the day-to-day operations of that oil and gas company. And so you can have these relatively small scale but important conversations kind of firm by firm across the energy sector.
Right.
And then we're having the broader conversations, what happens across the state of Texas, what happens across the country of the United States. And if we use all three lenses and do it in a way where we're respectful of the fact that there is meaningful energy poverty in the world, there's a lot of quality of life improvement that's available to unlock. And there's a lot of improvement around environmental sustainability, around access to energy, all of these things. And if we don't unduly create conflict amongst those, we can create an energy system that helps us achieve all the goals that we have, not in these unrealistic timeframes that we get to. We're not getting into net zero by 2050. Like I said, there's just really there's not enough capital on the planet that would allow you to get there in a way, particularly when you think about the cost to quality of life that would occur in such a rapid transition if you tried to push it globally all at the same time. But there are more nuanced, more pragmatic conversations that we can be having. My hope is that, as a global energy community, we start introducing even more of that pragmatism in our conversation. And I'm trying to do my small part in that.
Well, I'll tell you what, how do people find you?
The easiest way is to find me on LinkedIn. Every day, pretty much, I post a data-driven energy post, and then I have a Substack newsletter called Foundations of Energy. I make sure that I post about that on LinkedIn, and people can send me direct messages, communicate with me there. It's the easiest place to get in touch.
Sounds great. Thank you, Jeff, for stopping by the podcast.
Thank you, Stu. No, I appreciate it.